Good morning and welcome to the investor webinar for Nutritional Growth Solutions, a company that creates scientifically formulated and clinically proven supplements to support growth and development in children. My name is Chloe Hayes, the Investor and Media Relations Manager for NGS, and today I'm joined by newly appointed CEO Steve Turner. Today, Steve will run us through the recently announced results and strategy presentation, which will then be followed with a Q&A session. To ask a question throughout today's presentation, please use the Q&A function at the bottom of your screen. Steve, I'll now hand it over to you.
Thank you, Chloe. Wanted to spend time and walk everybody through our strategy presentation for the ongoing year and financial results. So without too much time on the disclaimer, if you'd like to read this in detail, please refer to our financial disclosures on the ASX. It's also available on our LinkedIn publications. Quick corporate snapshot of the company. So NGS, we actually specifically focus on children's nutrition, evidence-based, science-based products. We have a whole host of items in the portfolio, and we recently began selling in our retail journey at Walmart this last Q3 of 2022, with Healthy Heights being merchandised in over 400 stores nationally. We've actually had significant sales results, providing opportunities for further expansion, which will continue as we go down this journey. I was recently appointed CEO, and this is our current makeup of board and management and basic key metrics on the company. So without further ado, let's walk into the investment highlights. So obviously change is the name of the game. So I was recently asked to step in as CEO, really to drive our next stage of growth. North America has been the one market that we really have a lot to be proud of. It's really going to provide us with a lot of tactics and assets that allow us growth. Currently, our retail expansion plans are on the shoulders of Walmart. We're currently on shelf with 2 items, with more coming in future periods. Obviously, there's a lot of future opportunity in other markets, and we're going to look at how we can enter those markets in a test-controlled way that basically are lower risk, that give us the ability to look at incremental sales, all built on what we're doing here in North America. Our margins are very strong and attractive. We've actually been able to gain an increase in our gross profit margin, which is really a direct result of our channel sales strategy. So the more we sell in physical retail and online through Amazon and our website sales, the more margin we're able to garner, because the costs of working through a straight distribution model aren't nearly as profitable. So we're going to continue to unlock that overall opportunity with high margin and potential growth. Again, we're really built, based, and founded on the core innovations that stem from the Schneider Research Center in Tel Aviv, Israel. They see a large number of kids that have a variety of different need states. And the work that we're building on really culminates on decades of research that was actually done by our key founders that are obviously still actively involved in our daily activities, as well as on our board of directors. Ideally, what we're trying to tap into is that reality that there's a significant gap between actually getting quality, healthy nutrition in our daily diet in order to provide our children with the necessary building blocks for them to grow and thrive. There's actually a significant gap across a variety of different geographies, and we believe that there's really no true, simple, effective solution in order to basically alleviate those anxieties. And that's really what our goal is and what we're capitalizing on in all the markets that we operate. When you look at the work that's been done behind the product, I'm sure many of you may have seen these studies, publication as far as what was done on our core product known as Grow Daily 3+. But in the end, we were able to show a significant, highly statistical significant improvement on quality of growth and development, both within our treatment state, but also within a variety of ages across the range. And this is really kind of where it all started. When you look at the opportunity, there's a significant gap, especially with other brands geographically dispersed across the globe, that basically are not communicating in that space between age 12 months and up. Typically, there's a lot of really great content for infants, and then it sort of stops when you start looking at our target demographic. So we have a lot of opportunity. We intersect a variety of different markets, and of course, that's evident with the growth that we've seen specifically in North America over this last year. This is the current portfolio, and really it's really built on being able to find opportunities to capitalize on where other brands are failing to have the conversation and filling the gap, basically providing a variety of items that meet different age groups, different genders, and really sort of building our platform for growth. You'll notice there's a mixture of packaging formats. We really have currently 4 product families. We have the legacy product with Grow Daily 3+, which was the first product that was studied and published that's specifically for children ages 3 to 9. We have our Boys 10+, which is ideally formulated specifically for the needs of preteen and teen boys as they're growing and hitting their growth spurts. That was also developed and clinically studied and published. And then we have our Kids Protein range, which is available both in a dairy-based variant using whey protein as well as a plant-based vegan formulation in order to make sure that we can segment the different consumer needs in the opportunity that presents us as far as our growth and expansion. I came on board a little over a year and a half ago. I actually was brought on board as president for the North American operations to lead our charge in expansion in retail growth. So I have well over 20 years of experience specifically in this space. Started off both on the product design and development side, working my way through pharmaceuticals and OTC products and dietary supplements, and then crossing over into managing the development teams, interfacing with both investors and market makers, as well as our medical community and scientific staff as it related to business development activities, ultimately gaining corporate experience in a variety of different companies, really on building OTC products and companies or verticals within existing organizations, and really just sort of leveraging that aspect. I do fundamentally believe the opportunity that presents us that we've been able to capitalize on is becoming a resource for retail because in a lot of cases, most of the decision makers are overworked and responsible for a very large part of the P&L for a lot of these different retailers. And by going in and being able to provide them resources, access to insights, education, and data, it helps them become better, but more importantly, provides us with opportunities where we can capitalize on getting into the market. When you look at the past 12 months, realistically, I think what we've achieved is pretty significant. The fact that we've laid a significant foundation for growth is pretty exciting. We've done a 100% tactical overhaul of all of our external agencies and partners. We've changed the way that we're engaging with the end consumer and evolving that conversation to be able to tap into the most important element, which is emotion. Emotion is what we're going to be able to build and cultivate to be able to drive top-line sales and growth. Because of what we've been able to do and because of what we represent, we were also able to capitalize on some interesting market dynamics and secure business with the world's largest retailer. This is a phenomenal accomplishment given really where we are as a business and with our product, and presents us with a significant opportunity for growth. And our goal is to continue to leverage that strong consumer demand that we've been able to demonstrate is real, continue to lean in with Walmart and leverage that relationship to be able to gain additional distribution with other retailers, which really provides us a significant opportunity for growth going forward. When you look at the pillars of what we're trying to accomplish, ultimately our strategy for the year is to continue to use tactics that support sales velocity, because our fate and goals for growth are going to be directly tied to how well we can sell off of the shelf in all of our points of distribution. And we've actually been able to demonstrate a pretty significant achievement in a very short period of time. Realistically, we've been in the market since roughly October last year, and we're already overachieving on our initial sales expectations that we didn't even expect to get to until at least a year on shelf. And our sales velocity continues to increase week over week over week. And because of that, that leads to our second point of strategy, which really is to grow the number of stores that we're in. It's really a combination of sales velocity and our points of distribution that lead us towards a future business that is significant. Ultimately, the long-term goal is to have roughly 70% of our top line revenues coming from physical sales in brick and mortar stores, with only 30% of it being e-commerce or digital driven. Gives us a much more stable revenue stream, but also is realistically more appropriate for really the pie that we're trying to participate in as far as North America. And then each market's going to have its right balance. Obviously China is a little bit more advanced than the rest of the world on their e-commerce sales, but there's still a significant portion, 50, 60% or more, that are still sold in stores. So obviously the retail piece of it is an important part if we want to maximize our opportunities. We'll continue to be smart about how we expand. We're going to capitalize on the fact that we have a great asset, both with our medical team at Schneider, as well as the team that we've assembled from North America. And we have products coming. So one example is our recent announcement that we had with Walmart confirming our third item going on shelf later this year. So we're sitting on a business that actually has real business, has real distribution with Walmart, and that's one of the things that we're really looking forward to. And because of that, because of our sales velocity, because of what we've been able to accomplish as far as answer the question whether or not consumers actually have that demand, our expectation is to be able to leverage what we're doing with Walmart to gain sales at other retailers, Target, Walgreens, Boots Alliance, CVS, you name it. So basically continuing to go where we deserve to be, that we've been able to demonstrate thus far with Walmart. And below all of this is our foundational aspect related to our Amazon and our e-commerce web sales, because that is the machine that gives us the resources, the near-term instant cash flow that we then can redeploy back into our efforts to can gain additional footfall and grow our retail expansion. When you really look at Walmart, I think it's important to understand the magnitude of their business. And interestingly enough, their most recent IGD research report showed that Walmart's revenues last year were $600 billion. So they are a monster as it relates to channels, and they are all omni. So they view themselves both physically in store as well as e-commerce, and they treat that really as all one omni-channel experience, which is what sets them apart from the vast majority of retailers, at least in North America. But when you look at how great our business has been on Amazon, and you compare Amazon in contrast to the potential total dollar revenue that Walmart generates, you can really see why it's exciting that we're actually partnered with them and already have existing business that we intend to grow. And when you look at our performance, the current performance that we've actually been able to already demonstrate in a short period of time shows a pretty significant opportunity. Over a period of time, we fully expect to not only increase the number of items or SKUs that we have on shelf, but we also fully expect our store count to increase. And these two tables are really just meant to illustrate the opportunity as store volume increases or as sales velocity increases, combined with SKU count increasing, the numbers get big fairly quick. Realistically, Walmart controls a third of all commerce. They represent 33 to 35% of all commodity volume, which literally means 1/3 of everything sold predominantly in North America is moving through a Walmart door of some sort. The next largest part of the pie, of course, is our leading drug play between CVS and Walgreens, constantly fighting back and forth, and they each represent roughly about 15 to 18%, depending on the data, depending on the year. So really you have this account that we happen to already be in commanding a significant opportunity for us. They move a significant amount of volume in a very small footprint as far as total doors. So even though we're only in 409 doors, that's a pretty significant accomplishment, because that actually translates to thousands of doors of another retailer that wouldn't necessarily have the same overall movement and velocity on product. When you look at our marketing strategies, again, it's all about centering everything that we do around the end consumer. And Healthy Heights basically has been able to tap into that emotion. We've really shifted the dynamic on how we're basically engaging with the end user, even though we're small, by basically using tactics that work, that are known, that are supported. And we have the ability to leverage both paid and earned media, utilize multipliers like social influencers, key opinion leaders, doctors and specialists that happen to be moms and dads as well, that basically allow us to elevate and amplify the message and really get out there in front of them, get on the screen that's relevant. 90% of most of the traffic that we see is on mobile. So again, it's basically making sure that we're relevant on the screen in front of he, she, mom, dad, aunt, uncle, grandma, grandpa, in order to basically drive footfall and continue to support our sales in store. So we really have a flexible model. Obviously, licensing is where we started. The flagship licensing that we did was the funding event. There will continue to be opportunities where we can license the intellectual property that has been created by Schneider that we are custodians of, as well as gaining additional distribution. We've got opportunities to continue to expand our footprint in a way that enables us ultimately to grow the business, as well as building on our business or B2C or directly to consumer activities, both with store distribution and online sales of the Healthy Heights brand in North America. When you really look at the agenda, what's looking forward to us, this is a pretty exciting year. We finished 22 off on a really high note. We were able to obviously get distribution on shelf in Walmart in advance of when the clock actually starts to tick. We've been able to secure additional distribution with Poland, and we've seen substantial growth in our sales velocity on shelf. What that sets us up with is additional expansion. So we fully expect to see more stores awarded to us over time. Obviously, that's why I'm here to continue to drive this growth, because ultimately this is the opportunity that we have that presents us with the largest potential speed to continue to scale our business. We fully expect to enter Australia in both the independent pharmacy channel as well as B2C direct fulfilled by merchant on Amazon Global in order to basically continue the opportunity to get in front of consumers in every market, obviously stemming both from US activities as well as where we have operations on the ground. And ultimately continue to increase our SKU count or items on shelf as well as store count with Walmart. And then tap on additional markets, Southeast Asia distribution agreement, and others as we continue to go in a controlled fashion, really all built off of what we're doing here in the US. So by the end of the year, fully anticipate to see our third item already on shelf. Since that's been confirmed, it's very likely that we may have more. We should also be able to leverage what we're doing with Walmart to gain other retail distribution with additional stores. And of course, we have studies that are currently ongoing that we expect to be able to announce preliminary results on in the fourth quarter. So at the end of it, it's really our three-pillar strategy, all built off of what we've been able to accomplish, the successes that we've had here for the US, continuing to expand our ability to capitalize on the market opportunity that we are fitting within, as well as looking at global opportunities where we can either work with strategic partnerships or be opportunistic with US-based products to enter into these different geographies in a lower risk, high reward way, as well as, again, leveraging our sales channels. There's so much opportunity for us that is in front of us as we continue to move forward. That's the lion's share of what I wanted to share. So I'll turn it back over to Chloe and the team to field any questions.
All right, well, thanks, Steve, for the overview. We've had a few questions come through today. So the first one that we'll start with is, with Walmart already having initial sales success, when do you expect to have other major US retailers stocking the brand?
Well, that's a good question. There's actually two parts to this. The first part is understanding that retail looks in the rearview mirror, and they use data and insights that are provided by two of the data firms, either IRI or Nielsen, where they're actually capturing scan data, which literally means every little widget that's scanned across a cash register anywhere in the country is logged in their database. But it's always looking back because it takes them roughly a quarter to tabulate that data in order to then put reports together to share it with the retailers and with the world. And companies like us, we pay money to get access to that data in order to understand what is it that consumers are voting with as far as dollars exchanged. So there's a time lag there. So it is actually still true that we are intentionally, by design, because of how the data is reported, still sort of behind the curtain. So it's really about when do we get the opportunity or the forum to stand up on our soapbox and shout loudly so people can see what we've accomplished. And that's actually happening this month. So this week we are attending for the first time as a company the Natural Products Expo, which is the world's largest natural products expo for companies that are brands that are consumer facing, where we get together and we basically get to show off what we're doing. What's important is there's going to be 3 days of activity where retail merchants, retail planners, all the way down to the consumers, people actually shopping in a variety of different stores around the country, are coming to see what's happening. So it gives us the ability to basically show that we're a real company, that we're present, that we're not just a digital operation running out of somebody's garage. And then the second factor of that is when we have our actual retail review and engagement meetings, which also happen in the month of March. So at the end of March, we participate for the third time now as a company as part of what's called ECRM, which are these retail-facing merchant buyer meetings where we get to sit down one-on-one for 30 minutes with everybody that is in attendance. And so we typically have anywhere from 50 to 90 meetings over a 5-day stretch. And so that's going to be the forum where we get the actual decision makers in a private meeting, get to share what we've learned so that we can answer the question before they ask it as to, do you deserve to be on shelf? Do you have the demand? What is your expectations on velocity and sales so that we can help them quantify what the potential is? More importantly, the money they're leaving off of the table by not having us in their stores. So that's all going to happen starting in March. Now, it's also important to understand that retailers think in windows of 9 to 12 months. So even if we secure business today, That will be business that we won't be able to realize until 9 or 12 months when they actually set their modulars or their planograms. Some of the phrases you'll hear me say are MOD or POG, and that's really just an acronym to basically define, the physical merchandising assortment that we would exist in, is often governed by a person that controls a category, and they're responsible for the P&L of that category, and we basically have to sit down with them and start that process. And so they think of it sort of in time frames where they're able to react, which is typically 9 to 12 months out.
Okay, great. So our second question is, you talked about sales velocity, otherwise known as sales per week per store in Walmart, and that the company is currently achieving a sales velocity of 1.2 in over 80% of stores. Could you please discuss the potential sales velocity for other large US retailers?
Sure, it varies. Walmart has the wonderful dynamic of having the highest relative sales velocity as far as total volume of product that they're moving off shelf. So on average, it varies by channel. So I can tell you that the usual expectation within the drug channel, which would be your traditional retail drug stores like a Walgreens, a CVS, or a Rite Aid, a healthy item is going to generate anywhere from a quarter to a half a piece per door per week. And that would be a great item, because when you look at the total number of doors, for example, Walgreens Boots Alliance controls somewhere in the neighborhood of 11,000 doors. But the brutal reality is in 11,000 doors, Walgreens only moves roughly 18% commodity volume, where you contrast that to the 3,500 doors Walmart has, they're 2.5 times the dollar volume size. And so drug is usually a good benchmark between a quarter to a half a piece per point of distribution. Food is going to be closer to Walmart. Realistically, you'd like to see items that are in that 1 or velocity of 1. But really, it's about either the dollars per door that you can generate or the total line of business and the margin contribution that you're providing them that often dictates why a retailer would want to put you on shelf. So obviously, we are an emerging brand, and emerging brands historically are part of this ecosystem that when you look at the entirety, they're not going to get nearly as much margin from a Procter & Gamble, for example, on some of their items. Whereas they're going to get a little bit more margin from a smaller company like ours or other smaller emerging brands, but their expectations on the total volume of velocity is lower because, of course, they wouldn't expect it to perform the same as, say, a large, well-known established brand. So we're going to move through this cycle over time where right now we're emerging. Eventually, we'll get to a point where we stabilize, but then some future point in the future, we're going to need to defend. So our margin structure and our overall sales expectations will change throughout that cycle, but it'll vary. So it's interesting to note that when you look at our performance at Walmart, we actually have a few doors where we're selling at a 7. And I want to sort of illustrate the magnitude of what that would mean. That we literally have continued repeat purchases at this particular store, where we're selling 7 units per door per week, which is over 14 times what we had hoped to achieve even after a year. So obviously it's going to vary. There's going to be demographic tendencies. There's going to be geographic tendencies. There's going to be socioeconomic tendencies that ultimately line into it. But the one thing that we've been able to demonstrate, which is important to be proud of what we've accomplished, is we have a premium item that has a lot of horsepower in it, how it's designed. That's sitting in a category next to items that are, in some cases, half or even a third of the cost. Yet the consumer has shown, even in this economic time, the desire and interest to buy the item. Not only are they buying the item, but we're selling every week, and we're selling more and more, so that velocity just continues to build. And so, if anything, we've clearly demonstrated in really worst case scenario, where price leadership and cost sensitivities with consumers are high, that we deserve to be on shelf. Now it's really a function of continuing to use those learnings to get better at what we do and unlock more distribution.
Right. Our next question is, with the company focused on the US, is there an opportunity to sell into Canada as well?
There is. That every geography is going to have its ups and downs, pros and cons. Right now, the quickest way for us to move the needle that allows us to test different geographies is finding ways where we can enter those geographies without rebuilding. And to get into Canada, the challenge that we're going to have there, of course, is Health Canada is pretty specific about products like ours. We would require registration and approval in order to basically sell that product on a shelf. But there are groups that can help us through this journey. So we're actually talking with folks and evaluating really the best way to enter Canada. Canada, the challenge you have is because the provinces are so disparate, they're spread apart, the logistics aspects of it in order to basically support sales are pretty high. So the cost of sales in Canada is higher than what we see to support US or even really virtually any other market. And so it's making sure that we understand all those pieces, know which items ultimately we feel will be successful with, and then beginning that journey. But that's a build that will take a while because of the registration requirements, the dual language requirements for both French and English in that geography, and other differences in order to basically move on it. But it's absolutely on the horizon. I think the first markets that we're going to be looking at will be where we can enter sort of a hybrid digital e-commerce strategy, utilizing Amazon Global, Rakuten, and others, where we can actually take US product manufactured off of our existing lines so that the risk is very low and I only have to siphon off a small quantity in order to test these markets, see which items in our portfolio resonate with that geography, and then start planning on how do we nationalize or localize in those territories.
Okay, great. Next, can you please define a SKU? How many products/packages are in a SKU?
The SKU is a stock keeping unit, and that's trade retail lingo for your widget. Here's my SKU. This is a pen. So the retail side of life always views things at what is the lowest selling unit within a package. So in our case, a SKU is quite literally a box or a bottle or a canister of a product. In this case, Grow Daily. And so we actually sell to Walmart in case quantities, actually in pallet quantities, but they break it down and put that individual stock keeping unit on shelf, and that's what sells. So that's what a SKU is.
Perfect. Where is the product manufactured for Walmart? Is it being produced in the US?
Yes, that is actually one of the most exciting things that we have to offer. The intellectual property, the concept and creation of the nutritional mix that comes from Schneider, that's the gold. But we have the ability basically to localize it in every geography that we operate. So all of our manufacturing's done currently in the United States. We manufacture, assemble, and source the vast majority of every ingredient, if not all of them, that we can with US materials. Because of that US footprint, it actually provides us opportunities. One example that you may or may not be aware of is we were invited to participate in Walmart's open call process last year. In the 23 years I've been in sales with consumer products in the US, I've never had a product that was made here. Pharmacare, most of our materials came out of Europe. Strides, everything was coming out of India, so on and so forth. And so interestingly enough, Sam Walton in his vision set aside $3.5 billion with a B to be earmarked specifically to support US brands, emerging brands, and companies within the United States. And so we applied. As it turns out, we were one of 17,000 companies that applied for this program. Only 1,000 were selected. It felt very much like I was going to Willy Wonka and the Chocolate Factory. We participated in a 2-day event where we got the opportunity to basically sit down with a one-on-one pitch after watching all their great stories about how great Walmart is, and participate in a review. The culmination of that review turned into an hour-long meeting that ultimately gave us the opportunity once again become a resource that directly resulted in our new item that's coming in the fourth quarter this year, which is Happy Tummies. So again, we were basically able to provided an opportunity because we are a US business. We manufacture the product in the US, and we were able to capitalize on that opportunity. So we fully expect that as we look at every one of our opportunities long-term to be able to have an offering that's also localized, because there'll be unique flavor preferences, so on and so forth, with every country that we intend to grow in.
Great. Could you please elaborate on the patent protection that the company has for its products and how this acts as a barrier to entry?
Sure. So the current patent portfolio consists of six patents that were filed on the WPO. So they're global in nature, and we've nationalized them in a variety of different geographies. We have one composition of matter, which is fancy for saying the formula or the makeup of the product that's very specific. And then we have five method of use patents that basically would prevent anybody else from using a similar formulation that has a similar combination of macro and micro nutrients for the purposes that we are marketing. And so that prevents other companies from basically directly competing with us in the form of how they engage and market their product. And then, of course, anytime we find an infringer that we feel has basically doing the same thing that we're doing, marketing it and selling it and positioning it to consumers in the same way, it gives us the ability to basically send hate mail and or potentially sue them for treble damages, which would be directly tied to whatever the lost potential sales or whatever sales they generated infringing on us. And so that's kind of a nice position to be in. But what's also important is, aside from the patent portfolio, is the clinical work that was done at the level of what you would traditionally expect to be seen for a prescription drug. Was done at a site that is really the global epicenter for growth and development issues in children, and it was done in our target demographic at a fairly large scale. Not only that, but the results and commentary were published in a peer-reviewed medical journal. So it's the real deal. You have a lot of what I will call intellectual property between the science work and publication, as well as the patents themselves, that give us really a compelling point of difference.
Okay. The presentation mentions a 49% gross profit margin. Is this purely top-line revenue minus the costs of goods sold, or are some minor expenses included in this?
In that particular calculation, it covers all the expenses as far as what we are looking at from the selling expense side of life. It doesn't cover, obviously, full operational load. So the money that we're actually putting in the bank at the end of the day is lower than that. But it's also just an indication to kind of show really where our margins are solid, have improved even more so. But realistically, when you look at our portfolio assortment in general, we're following a practice that I like to continue to instill, which is a 60-40 or a 65-35 ratio. So in reality, the actual gross margins of our items are in the 60% range. And then you have to factor in, however, trade terms in that initial sort of cost of sales componentry that ultimately whittles it down. And the reason it's improved, as I pointed out earlier, is because the more we sell that we control. So, for example, the more Walmart, the more Walgreens, the more CVS, and the more Amazon and the more our web sales, the margin improves because we get our total gross revenue line closer to that true gross margin line, which is the actual cost of goods less the initial terms and inbound and outbound freight. So that's just showing that we've done a better job at selling more outside of traditional distribution, which typically takes quite a bit from your gross margin.
Okay, great. Our next question is, will the new Happy Tummies product exclusively be available at Walmart, or can the company sell this to other retailers as well?
So yes and yes, and this is going to be a fun answer for you. So our expectation and my discussion that I've had specifically with the merchant team is that they want to have exclusive in-store distribution for that particular item and its configuration as designed. But they want the omni experience to be non-exclusive because they benefit from as many eyes getting on it as well. So we will be able to sell that specific item everywhere other than other physical stores for that particular flavor, design, count, and configuration. However, because we were leading the charge on basically delivering on an interesting product specifically for Walmart's wish list, it led us to actually introduce 6 total variants when you look at Happy Tummies. So the item that we're actually going to be putting on shelves at Walmart is Happy Tummies Plus, which is a combination of a soluble plant-based prebiotic fiber to feed the organism that is the probiotic, combined with protein. It's flavored and it's a really great product. It's a great juice substitute, but more importantly, it's just going to be phenomenal. It has so much more than what our competitive frame in, and we're still using high-end clinically studied premium ingredients. So it's quite literally like putting a Corvette next to a Volkswagen Bug on the shelf and giving the consumer to buy them both at the same price. So we really expect that to do well. But because of the work that we did behind it, we actually have a variant without the protein. And we have 3 flavors of each. So we're going to negotiate and work through with Walmart. Ultimately, the end conclusion is likely going to be they want one particular item of that to be theirs, leaving us free to be able to potentially capitalize on the other 5. So we're actually going to be talking specifically about what we've done this week at Expo, as well as with our retail meetings this month, and be able to use that to basically gauge our ability to enter into a new segment within the category, which is the more traditional vitamin set, which is where probiotics and digestives and fiber supplements typically exist. So it gives us the ability to sort of branch out more with Healthy Heights, and just gives us, again, better odds at gaining more distribution.
Great. Does NGS plan to ramp up sales through its own website, or are you more focused on sales through other platforms such as Amazon?
Well, we want to do them all. So every channel, our website sales currently are on our Shopify site, which is the e-commerce portal that we utilize for healthyheights.com. That one's important for us because we keep the delta between what our cost of goods are and what it sells for. But the audience and reach of that particular portal isn't as big as what we get with Amazon. And so all of them sort of are synergistic, almost like a symbiotic relationship between what we do on healthyheights.com and what we do on Amazon and what we do at Walmart. And so my goal, of course, is to grow all of those. And some of the things that we've done over the last year that you don't see are basically what we've done below the boot, below the bonnet or below the hood. I want to make sure I'm using the right terminology. But basically, the engine inside the car has dramatically changed. And we've dramatically increased our conversion rate, almost exponentially. We've actually been able to lengthen the time at which our subscribers stay within our platform. The amount of money that we're able to extract over a longer period of time is higher than it ever has been. Again, we've continued to do a variety of different things that basically allow us to talk to a broader audience, tap into that emotion, and more importantly, find tactics to be able to support higher levels of sales. So our daily sales continue to improve on both Amazon and our web store sales. And that is important because it's near-term instant cash flow for us, as opposed to the typical cash flow that we would get from Walmart, for example. And so we need to have both and fully expect to continue to build on those because it gives us, again, our own soapbox that we get to stand on and craft our own message versus trying to sell on somebody else's marketplace.
Great. Well, that's all we have time for today. I'd like to thank the audience for the questions and Steve for joining us today. We will be making a recording of today's webinar available on the NGS website and social media platforms over the coming days. And if you have any further questions, please feel free to reach out via the contact details at the bottom of our ASX releases. Thanks everyone for joining us today.
Thank you.